What's going on, guys? In this video today, I wanted to go over something that I find really interesting to kind of run every once in a while, run the numbers and see how things come out. So what we're going over is how to potentially create a full-time income, basically trading. So in this instance, I'm looking at my own personal case and I'm looking at options trading and how I could basically build my portfolio around the potential in the future of having a full-time income, basically just trading options and a couple different strategies. So that's what we're going to go over today. I hope you enjoyed the video. If you do, make sure you drop a like down below. And if you want to see more videos like this one, make sure you hit that sub button. So I've broken these out into three basic steps that we'll kind of look at and go over today. And the first one here we have is creating an actual business plan. So what you're essentially doing is creating a business, right? So you need to kind of take your trading to that level where you're looking at things from a business aspect. How are your financials coming in? What is what are your expenses? And then kind of what are your actual returns? And you need to kind of make sure you're tracking everything and having a good idea of what's kind of coming in as well as going out. So the first thing that I've kind of looked at here is I generally spend around $1,800 a month. It kind of obviously fluctuates, but I know that I'm generally around that for rent, food, gas, car expenses, whatever it may be. So what we're looking at, right, is my monthly expenses and then putting that over the year and then basically finding out, right, after taxes, which I just said 35% on top of this 21,000, we come out to a number of 29,160. So basically that is the amount of income I would theoretically need to produce to be able to live full-time on that income, basically. And obviously I'd love to make more than that, and I do make more than that, so that accounts for some of the investing and some of the other things. But basic living expenses, kind of having that stuff covered, having that peace of mind, that is how much I'd have to make. So what we can do from there is we can basically, the other number that we need to know is what is our return basically from our investment strategies, which I'll get into here in this video on kind of the next slide. But what if you want to see more in depth of kind of how I get to these numbers, tune into my next video. And you'll kind of see a breakdown of my year kind of trading options. I'm going to go over 2021 and kind of how all the options have broken out. So I'll like I said, I'll try and link that below, but that'll be the next video, so make sure you subscribe and catch that one. So what we'll look at here is basically what I'm estimating my return for the year to be every year, which obviously isn't completely accurate because you are going to have drawdowns and have other things. But what I've seen so far this year is around a 20% return over the entire year, which sadly is a little bit less than the S&P this year. But again, we'll break that down in a different video. So what we're going to do with that then is we're going to do a little bit more math and basically break that out to how much money do we need with this return to be able to yield $29,000. And what that comes out to is $145,000. So you can see the math here. Basically, I'm just taking the amount of money that I am looking to achieve in a year and dividing it by my return, and that gets me to that $145,000. So like I said, that is obviously a perfect situation. So that is, I'm utilizing all of this money and I'm achieving a 20% return. So what I've done on top of that, which is kind of good in any situation, is I've built in a contingency. So what I like to do, even currently, is use around 30% of my account, basically keep that in cash. So what I've done here is added a 30% contingency on top of that, and that brings me to basically a number of 190,000. Again, here's the math. I'm just taking the 145, multiplying it by the 30% to get 30% of this, and then adding back the 145, and that gets me to the 190,000. So basically what this slide is kind of saying and breaking down is that I would need $190,000 to be able to achieve around $30,000 in yearly income from this account. And again, that's with a 30% contingency of cash, and not super not, I wouldn't say overly conservative return year over year. Obviously this year the market's traded in one direction, so we could see drawdowns and different things that would affect this return, but as of right now, that's what I'm seeing in my account. So as I kind of discussed, you need to have strategies and a good understanding of how you're going to actually execute your plan. So right now for me, my primary focus has been on credit spreads and the wheel strategy this year. Overall, I want to try and start getting into leaps as kind of a third option, and then covered calls as kind of a longer term. Once the account gets built up, basically what I'm doing is I'm using these two strategies to create profits and then rolling those profits into SPY. So then I can get a return on SPY, get dividends, and then hopefully also work on selling covered calls against my SPY shares once I build it out far enough. So that's kind of what I'm looking at. Those are the four strategies that I am personally most comfortable with. Credit spreads I see as the highest risk strategy because you're essentially risking a total amount of money. I'm trading like $5 wide credit spreads, so I'm risking $500 on every trade to make around $20. And basically, right, I see that as the highest risk. Wheel is a little bit lower risk. Obviously, you do tend on smaller accounts to be in more speculative stocks, so there's a higher risk with that when you have a smaller account. But as you grow your account, you can be in bigger stocks like Apple, Microsoft, Google, kind of some other accounts, some other stocks that are more conservative and have a more conservative approach. Leaps, I haven't gotten a ton of data back on because I haven't ran many leaps options, so I don't really have any return in here. But basically what I'm doing here is laying out what I see as an upper or a lower return for that strategy, and then an upper return for that strategy. So credit spreads right now, because of how my strategy is set up, it's very concrete. Again, tune into the next video to see kind of an actual breakdown of everything. But because it's so concrete, I generally have kind of broken out, and I've ran a year, actually more like 8 months of credit spread trades. So I've kind of seen that in total, I'm coming out to a 20% return, and that is a very, I would say, strong number because of the data that backs it up, the drawdowns that we've seen in the market over the last few months, and still basically being able to achieve that return. The wheel strategy, a little bit more speculative, like I said, on smaller accounts. So I'm seeing anywhere from 20% to 50%. That doesn't really include appreciation. So if you add a stock appreciation into that, you can have even higher returns there. Again, leaps, like I touched on, haven't ran a ton of them. Covered calls, I've ran some of the numbers on SPY, and I'm seeing anywhere between 5 to 10%. In some cases, you can get up to 15% if there's a lot of volatility in the market. But right now, that's kind of where I've seen. So again, this is longer term. Once you get a bigger account, you want to be a little more conservative. So that's why this is kind of a fourth option on here. Once the account gets bigger, start implementing some of those covered calls. So drawdown potential, this is basically what I've kind of seen and numbers that I've come up with if I ran into bad situations. So 35% for credit spreads, basically from what I'm seeing, again with my strategy, is if I ever run into a bad situation where I have to either exit a trade or roll a trade, generally speaking, I end up losing 35% of my $500 or $5 wide spread. So that's where I'm getting that number from. And then wheel strategy, you can see 50 to 65%. That's kind of the problem with the wheel strategy is you're normally selling puts below falling stocks. So as a stock is falling, right, you're trying to sell a put at where you are comfortable buying shares. But in a lot of cases, because these are speculative stocks that you're generally running the wheel on, you can try and basically catch a falling knife, and if you don't time it perfectly, then you can run into situations where your account is down 50% in some situations, or even 65%, just because the stock has fallen so much. The good part about the wheel is it always has the opportunity to rebound the stock, so they're not necessarily always realized losses. So overall, those are the strategies that I look at trading, the kind of four here, and the potential returns that I see with them, and then the drawdowns, potential drawdowns with them. So the last thing we have up here is actually scaling your account. So once you finally figure out how much return you need, and kind of what your dollar value is that you need to achieve, your expenses, all that stuff. You need to actually set up a game plan and how you're going to execute it. So here we have the years. So we've done year 1 through year 10, and then we have the account value. We have how much we're actually adding to the account, and then our total actual gains from the account. What we can see is that by year 4 into year 5, we're actually hitting that $30,000 mark that we're trying to achieve. And we just can keep on going and kind of see how things compound. Or at that point, you could start withdrawing from the account and actually cover all of your expenses. Obviously, you have inflation on top of that, so you need to kind of consider that. So you might actually be at the year 5 mark, but it gives you at least a good idea of how you need to set up your account to achieve what goal you're actually trying to achieve. So just to go over the math real quick, what we're looking at here is you have 25,000 as the original account value. You're adding 25,000 over the course of the year, and on basically your original account value, you're actually achieving that 20% return that we talked about, and that equates to $5,000. So you can see if you actually add all these 3 numbers up, you actually get this account value for year 2. So this 55,000. And then again, that just kind of follows all the way through. So if you added all of these up, you get this 91,000, and then you kind of keep going over time. So as I mentioned, year 4 to year 5, you're actually seeing that transition period where you overcome the $30,000 mark that you're trying to hit. But what gets really interesting is when you kind of keep going at this for a longer period of time, and by year 10, your total account value by the end of year 10 would be $800,000, and you would have achieved $130,000 in gains on your account. So this gives you at least an idea of what to look for. This is the perfect situation. So this is you're always achieving 20% returns on your money. There's no drawdowns, no kind of hiccups along the way. So obviously you need to kind of build in some a conservative approach to this and figure out where you want to be and how you want to get there. But overall, this gives you a good idea of what you're looking at and what you would need in the future. One last thing, I always like to double check my work. So we're seeing $100,000 or $800,000 here, and what I've done is gone to a compound interest calculator on the internet. Current principal of 25,000, additions of 25,000, 10 years of growth at 20%. And you can see I also had to check, end of year that we're actually compounding, or making our additions. And when I hit the calculate button, we're getting 800,000. What's also interesting is kind of to manipulate these numbers. So if we want to be a little more conservative, we could say we're actually only going to achieve a 15% return year over year. So where would we be at? We would only be at $600,000, which still obviously is an incredible return, a little bit less, $200,000 less than when we're at 20%, but you can kind of manipulate these numbers and see how they develop over time. So if we're down at 10%, we're still at $500,000 over 10 years. So overall, kind of a good thing to look at, good calculator to run, and kind of see where you want to be and what time you want to kind of be there at. So in conclusion, right, we set up a game plan. So we looked at our business plan, we looked at our expenses, how much we return every year, and then built out a number of about what we would need to achieve our yearly income goals. We also looked at our plan of basically achieving those returns. So we saw the credit spreads, the wheel strategy, leap options, covered calls. That's kind of how we want to achieve that 20% return. And then finally, we laid out a plan of how do we want to scale our account. So how much can we add? What are our possible additions? So this is a very aggressive approach of adding $25,000 every year. So in conclusion, I hope you guys got a ton of value away from this video. If you did, make sure you drop a like down below. And if you want to see more videos like this one, make sure you hit the subscribe button.